Today I'm reviewing XLC, the Communication Services Select Sector SPDR ETF. This chart was captured on July 7, 2026. On the left, I'm looking at the weekly chart for the larger picture, and on the right, I'm using the 4-hour chart to study the shorter-term setup. What makes this example interesting is that XLC was showing several signs of a possible bullish recovery. But when we move to the second image, we'll see what happened when that recovery failed to hold. What I was seeing. Let's start with the weekly chart on the left. XLC had already experienced considerable movement from its previous highs and had pulled back toward an important support area. The weekly chart was therefore giving me the larger context. Price wasn't simply moving higher in a clean trend, there had been weakness and the market was attempting to stabilize. Now look at the 4-hour chart on the right. This is where things were becoming more interesting. XLC had fallen toward the swing low area around 106 to 107 and then started recovering. Price moved back above the rising short-term moving average and began pushing toward the important 111.20 area. Momentum was also improving. The MACD at the bottom of the chart was turning upward and the histogram had moved into positive territory. I didn't need the MACD to tell me to take a trade. What interested me was that it was confirming what I could already see in price. Selling momentum had weakened, buyers were responding from support, price was recovering, and the shorter-term structure was improving. There was also a change of character indication developing on the 4-hour chart. Again, I don't treat one signal as proof that a reversal must occur. Instead, I look for several pieces of information pointing in the same direction. Here I had support underneath price, improving structure, improving momentum, and a recovery through the moving average. The important resistance. The next question was whether XLC could continue through resistance. The 111.20 area was particularly important. Price had pushed back through that level, and above it I was watching the area around 112.26. This is where I have to distinguish between a market that is simply bouncing and one that is actually establishing a sustainable reversal. Moving through resistance is encouraging, but crossing a line isn't enough. I want to see whether price can remain above that level and continue building structure. At the time of image 1, the bullish case was improving. Price had recovered substantially from the swing low, momentum was strengthening, the 20 EMA was supporting the recovery, and XLC was challenging important resistance. But the market still had to prove that it could hold those gains, and that's where image 2 becomes important. What happened next? Now we're looking at XLC 2 days later. From this point forward, leave this image on screen. The difference is immediately noticeable. The bullish recovery didn't continue the way the first chart suggested it might. XLC had pushed into the resistance area, but buyers couldn't maintain control. Price reversed sharply. The move above the 111.20 area failed to hold, and XLC was now trading considerably lower around the 108 area. This completely changes how I look at the setup. Why the reversal failed? In image 1, the market was giving me evidence of improving conditions. In image 2, it was giving me new information. Resistance had held, the breakout couldn't sustain itself. Price had fallen back underneath the important 111.20 area and momentum was weakening. You can also see the change in the MACD at the bottom of the chart. The positive momentum that had been building in image 1 was beginning to contract. Again, I'm not making the decision based solely on MACD. Price itself is telling the story. The MACD is simply providing additional context. Support becomes important again. With price back below the breakout area, my attention naturally moves towards support. The area around 108 now becomes important. Below that, the larger swing low area around 106 to 107 remains another significant reference point. This is one of the reasons I mark support and resistance before the trade develops. I don't know beforehand exactly what price will do, but I know the areas where I need to pay attention. When price was moving higher, resistance was my focus. Once resistance rejected the move, support became increasingly important. The weekly chart also matters. The weekly chart on the left also helps put the move into perspective. The shorter-term recovery on the 4-hour chart didn't erase the larger structure. XLC was still operating inside a much more complicated weekly environment. That's an important reminder when using multiple time frames. A 4-hour bullish reversal can be completely legitimate, but it can still fail when it runs into larger resistance or when buyers don't provide enough follow-through. The shorter time frame gives me the setup, the larger time frame gives me context. I want both pieces of information. What changed between image 1 and image 2? The comparison between these two screenshots is really the entire lesson. In image 1, price was recovering from support. Momentum was improving, the 20 EMA was supporting the recovery, structure was improving, and XLC was challenging resistance. In image 2, the move through resistance had failed, price had reversed, momentum had weakened, and XLC was moving back towards support. Nothing requires me to predict this beforehand. My job is to recognize when the evidence changes. Trade quality. The important point is that we shouldn't look at image 2 and pretend image 1 was obviously going to fail. That's hindsight. At the time of image 1, there were legitimate technical reasons to pay attention to the bullish recovery. What happened afterward was new information. That's one of the realities of trading. A setup can make technical sense and still fail. What matters is what happens after the setup develops and whether price confirms or invalidates the original idea. What I did well. One thing I like about this setup is that I wasn't relying on a single indicator. I had the weekly chart for context, the 4-hour chart for the setup, the moving averages, clearly defined support and resistance, and momentum information providing additional confirmation. That gives me several independent pieces of information rather than relying on one signal. What I would continue to study. The biggest lesson I would take from this example is the difference between breaking resistance and holding above resistance. They are not the same thing. XLC demonstrated enough strength to move through an important level, but it didn't demonstrate enough strength to establish itself above that level. That distinction matters. A breakout gets my attention, follow through gives the breakout credibility. Key lesson. The main lesson from this XLC example is simple. A breakout is not confirmation by itself. Price still has to hold the level and follow through. Image 1 showed the developing opportunity. Image 2 showed what happened when the market failed to confirm it. That's why I don't need to predict every move correctly. I need to identify my levels, understand the structure, observe what price does, and respond when the evidence changes. That's the purpose of reviewing these trades. Disclaimer. This video is for educational purposes only and is not financial advice.